So the Fed just told Trump no. We had GDP smash expectations. Tariff news is back in the spotlight, and the Treasury just revealed its master plan to reshape borrowing costs for years to come. Today's news was a collision of politics, policy, and a resilient U.S. economy, but stocks show mixed feelings about everything going on, and we'll talk about all of the news pushing markets. But we wonder where we go from here, and we got a July survey from Morgan Stanley showing that 81% of Robinhood users, remember Robinhood appeals to more your retail trading crowd who's less knowledgeable about everything going on in relation to stocks. 81% expect that markets will continue climbing heading into the third quarter compared to 66% of the broader population who believes the same thing. And a quick look at the fear and greed index, we see that we're still hovering around in this greed territory, and we just wonder where we go from here. But all of this makes sense because it's a really euphoric and optimistic time in the stock market with stocks hitting high after high after high, and meme trading making its way back into the news. Retail investors account for about a fifth of the options market trading, and margin debt balances are blowing past $1 trillion, reaching record highs. Trivariate Research President Adam Parker argues that AI is the major reason why high valuations are justified, and that it shouldn't deter investors with stocks being at the valuations they're at. But there's some suspicion as earnings continue out, because stocks that beat on average gain around 1.6%. So let's say they rise 2%. But if they miss, on average, when stocks miss, they drop about 5.1%, showing that there's this risk on a larger downside than upside for stocks regarding earnings. A lot of people are sketched out about how things are moving, and it's really hard to please everyone out there. Just imagine the Fed and how they're making Trump feel right now. I'd imagine Trump's really unpleased because today the Fed decided to hold rates steady for their fifth straight meeting, keeping the Fed funds rate at 4.25% to 4.5% despite what Fed wants. And just a little bit history and education on who decides on rates. It's a 12-person committee that includes all 7 Fed governors on the central bank's board, who's appointed by the U.S. president at the time of their being appointed. The other 5 are drawn from among 12 regional bank presidents who vote on a rotating basis. And today was the first time since 2020 where more than one Fed official voted against Jerome Powell, and the first time since 1993 in which more than one board governor dissented, meaning they didn't concur or agree with. They went from more of a opposing view as far as what the Fed chair wanted to do, meaning that they supported cutting rates. So that would have been both Christopher Waller and Michelle Bowman supporting rate cuts. And then the other camps showed that Mary Daly supports cuts pretty soon, but wants more data, about 2 to 3 months out worth of data before she actually supports cutting rates. And then others see that these tariffs are going to drive up costs and stick around for a little bit longer, like Raphael Bostic, making it hard to support cuts here in the near term. But it makes sense when you look at the data going out, and GDP came out today, and what we've seen is that GDP for the second quarter came in with a surprise, growing more than expected, being boosted by exports after imports were weaker due to front running back in Q1 due to tariffs, growing at an annual rate of 3% from the 0.5% contraction back in the first quarter. A lot of people thought we were going to continue this contraction, and 2 negative consecutive quarters of GDP is what some would define a recession at. GDP grew at an average rate of 1.2% the first 6 months of this year, down from the 2.5% last year, showing that some impacts by tariffs were there were some impacts by tariffs with businesses being cautious, offsetting these consumer spending, which increased at 1.4% pace, being higher than that of Q1. So consumers spent more, businesses spent less. And a combined from both businesses and consumers wanes as the final sales to private domestic purchases, which is what that measures, rose at 1.2% rate in Q2, down from 1.9%, being the weakest since 2022. Even though GDP is growing at a slower rate, it's still pretty solid though, so there's not really many alarms here. And then we got the ADP employment report, which gives more signs into your private payrolls from smaller companies. And what we've seen is that this came in pretty strong too. So this came in at 104,000 versus the 64,000 expected. So this was a solid beat with solid wage gains. Consumers aren't feeling as good as businesses about the economy though. So we'll keep on watching this and seeing how the data continues to progress and come out. We got a major job report coming on later this week that will be more of what moves the needle as far as what happens with the Fed, how's the labor market showing up. This one was just kind of like your precursor to what to expect going forward, and they rarely ever move together. But if this one beat, I'd imagine a lot of people are going to expect the employment report coming out later this week to also beat. But inflation has savers feeling less secure about retirement, all in the face of people feeling pretty confident about how things are going and spending pretty well, and the GDP here in the US being stronger than expected. Americans are feeling less confident about their ability to retire comfortably than a year ago, partly driven by concerns about inflation. And I'd imagine this will play into tariffs and their tariff impacts. 34% of respondents said they are very likely to meet their savings goals in this year's survey, down from 43% in 2024. Inflation and market volatility remain top of mind for a lot of these participants that took place in this survey, and more participants are responding by reducing spending than cutting back on contributions to their retirement plans. Because hey, we want to keep on investing, maybe we'll just like eat rice and beans for dinner instead of cutting back on investing into our stocks that are going to help us retire one day. 40% of respondents said that they are making fewer purchases, and 39% said they are buying cheaper products, cheaper alternatives. Just 11% said that they are reducing their 401k contributions due to economic challenges. So we're seeing a whole bunch of mixed results, and I'd assume it's going to consider, but everyone is wondering about the longer impacts to what to expect with inflation, and we got more news regarding that is what we'll cover next. And I mean, you guessed it, it's tariffs. So Trump came out and started off the day saying, hey, this August 1st deadline is the August 1st deadline. I'm not extending it, y'all. I know y'all expect me to chicken out. It's not going to happen this time. No extension for the August 1st deadline. And then he came out, and we're kind of scrolling up because it's more recent as we scroll up on this article. He announced that India will face this 25% tariff rate and mentioned a penalty for buying Russian goods. And I'd imagine oil will be a big one because China and India are two of Russia's largest purchasers of Russian oil. We also got more news regarding tariffs because Brazil will get a 50% tariff, and this will start in 7 days on August 6th with some exceptions for goods already in transit. He's using the the International Emergency Economic Powers Act. And you notice how they put it right here, but it's not down here that it's mentioned, or maybe I missed it somewhere. That's what the courts are trying to decide on, whether or not Trump overstepped or not when he used them. And if tariffs are deemed illegal, it's the tariffs invoked using the International Emergency Economic Powers Act. So I just thought it was interesting they pointed this out, and that the rate was as high as 50% on this one. Then it doesn't stop there, because Donald Trump also on Wednesday, so today, said he would be meeting with South Korean officials later today to hear their offer to buy down the 25% tariff rate the administration has set. And he's said that he's shown a willingness to lower tariffs in return for commitments to invest in or buy U.S. goods, as was the case in recent deals for the EU, the European Union, and Japan. So we'll keep on watching this. We're just right around the corner, just a couple days away. Friday is the day to watch because that is the main deadline. But the tariff news doesn't end there either, so there will be more impacts. And this one will be in regards to smaller items, and it's called the de minimis tariffs. So this exemption that allowed people to buy low-value imported items without paying duty and import taxes. It's a custom law that allows imported goods valued below $800 to enter the country without incurring duties or formal customs procedures. Starting August 29th, that exemption will end for items shipped from every other country, meaning that imported items that are valued at or under $800 may now be subject to taxes and duties that weren't subject to before. Under the new executive order, all goods mailed through private shipping channels such as couriers and freight forwarders are subject to all applicable duties. Packages could be tariffed at a flat fee ranging from $80 to $200 an item, depending on the rate set for the item's specific country or origin, but there's another one. The duty could also be a percentage of the value of the item shipped. That percentage would be equal to the tariff rate imposed on the product's country of origin. But this is the one to note right here. This first option we just mentioned, the flat fee, the first method would only be available for the first 6 months, after which all shipments will have to comply with the second option. Certain duty exemptions still apply. The Trump administration said American travelers can still bring back up to $200 worth in personal items from their trips duty-free, and individuals can still receive bona fide gifts valued at $100. So that's a whole lot more news as to what's going on with tariffs. And the Fed was asked, Jerome Powell today at the press conference was asked about whether or not this announcements of tariffs and how we're getting closer to this deadline, does it give them more clarity regarding the tariffs and inflation and what they're expecting to do with interest rates, the Fed funds rate? And he pretty much said, nah, we want to see the data first. I don't want to make any commitments. We're not at September's meeting. We're not at a future meeting. We're going to continue waiting, looking at the data. We're data dependent, and we'll go from there. And he also pretty much said, he kind of like took a stab at Trump today and said, hey, y'all are lucky we're not raising rates today because goods prices have been seeing more inflation than they were. Although we think that it could be a one-off and a one-time price increase and then it disappears, there are Fed officials who see inflation sticking around a little bit longer, but that's kind of what we got from Jerome Powell today. But it doesn't end there, because another cost that's pretty high for people, not even tariffs, it's interest rates, especially for like 30-year mortgages. We heard from the Treasury today, and they revealed a plan on how they could possibly lower interest rates. At least is what I took from it. So the U.S. Department of the Treasury is offering $125 billion of Treasury securities. They mentioned their 3-year notes amounting about $58 billion, 10-year 42, 30-year 25 billion. And the Treasury will continue selling the same amount of longer-term debt, while the Treasury Department will increase the size of its debt buyback program, allowing purchases of up to $38 billion, which is up from $30 billion previously. And the focus will be more so on these longer-term notes and bonds, like these 10-year and 30-year Treasuries, which impact mortgage related costs, mortgage rates. And this is right as Bessent told the public that he'd like to focus on issuing shorter term debt and relying less on longer term Treasury issuance, because the rates are pretty high here. The government's going to increase the deficit due to the big beautiful spending bill, and Bessent's already said, hey, I want to get this 10-year Treasury yield lower. And the Fed, when the Fed lowers interest rates, they impact the front of the curve. So that'll be they impact the overnight rate, which impacts much shorter term treasury yields, not so much these longer terms like the 10, 20, and 30-year treasury yield. So this could be part of the master plan to bring yields down, lower borrowing costs for homes and for consumers, and possibly even the government when they continue issuing longer term treasury yields. Or at the very least, just offset the big beautiful bill's impacts on funding needs. But overall, today just revealed that the Fed is holding its ground against the political pressure for now. GDP is slowing, but it's showing that it's still at a decent pace. Tariffs are staying, but maybe the courts could change this or impact how these tariff rates are being handled, because they say if he doesn't get them this way, he'll get them another way. And the Treasury is trying to bring down yields, but we'll see how the bond market traders respond to this. So the big question now is, does this set up for an even stronger economy, or do we see a shift? Do we see the shift course from here, or do we see the course shift from here? Let me know what you think, and I'll see you next time, y'all.